Okay, let's talk about a few theories about capital structure, and we're going to start here with signaling theory. Firm structure is optimized when the marginal subsidy, the additional subsidy, or the next subsidy, the marginal subsidy to debt equals the marginal cost, the additional cost. So the additional subsidy equals the additional cost. Investors view debt as a signal of firm value. So remember I told you debt is leverage. So if the investors know that CEOs and CFOs know that debt is leverage. So if you put a lot of debt on a company, what is that signaling to the marketplace? That means that you believe that the company is going to grow fast and going to be very successful. Because why would you put a lot of debt on a company if you know debt is leverage and you are going to go bankrupt faster? So the idea of signaling theory is firms with low anticipated profits will take on low levels of debt. Firms with high anticipated profits will take high levels of debt. So the firm inside the firm knows that debt is leverage, and therefore when they're going to do well, they'll take on more debt to raise the profits for the shareholders, which of course, because they have stock options, would be raising their own profits. So that would be one way you could get a signal about how the company inside the company feels about the company if they're increasing the level of debt. And of course, the manager who takes on more debt than is optimal in order to fool investors will pay the cost in the long run. In other words, you can fool me for a little while by putting a much more debt on the company, but eventually that will catch up with you because now you actually will go bankrupt, and that will be a problem. The next theory is one we've talked about quite a bit, agency theory. Agency cost of equity is a little bit different. So an individual will work harder for a firm if he or she is one of the owners than if they are just hired help. You can see this in your own life all the time is, what do you want me to do and how much are you going to pay me for it is one attitude, and the other attitude is, we need to get this done because we need to win. So you've got to think about it as potentially an athletic metaphor would help. While managers have a motive to partake in perks, they also need the opportunity. Free cash flow provides this opportunity. In other words, why do you have a company jet? Well, because we have a lot of cash laying around, and we decided how to use it was to put in, $1 million requisition for a company jet, and that would be it would be nicer for the employees, and so they spend a lot of money on perks. If you didn't have the cash, you wouldn't be asking for those perks. So the hypothesis says the free cash flow hypothesis says that an increase in dividends would benefit the stockholders by reducing the ability of managers to pursue wasteful activities. In other words, don't leave the cash laying around. Take that cash and send it to the shareholders. And likewise, the free cash flow hypothesis also argues that an increase in debt will reduce the ability of managers to pursue wasteful activities that are more effectively than dividend increases, because even though you're spending the money, you're getting a tax benefit for it. So either way decreases the cash laying around that isn't being used. And when the cash is laying around not being used, all of a sudden you see all these perks for management start popping up. Private jets and lavish lunches and expense accounts and trips and company meetings at very expensive locations and so on. And that is shareholder money. That's shareholder money that could be used for dividends, or it could be used for buying back stock, or to pay debt holders and so on. So the idea of agency theory impacting capital structure is you want to make sure that you have enough money going out into dividends or enough money going out into debt that you don't have a bunch of cash laying around that can be used for frivolous purposes such as perks for executives. In addition to that, you have a pecking order theory, and the theory states that firms prefer to issue debt rather than equity if internal financing is insufficient. So the first rule is you, of course, use internal financing. That's using your own cash flow. And when your cash flow is insufficient, for example, the Home Depot store number 1 is not going to generate enough cash to build stores number 2 through 5,000, or however many stores they have. They probably don't have 5,000, but they've got hundreds of stores. And so the cash flow from that first store is not going to generate enough. So what do you do next? Where does that capital come from to build the second store? And so this would say that next you issue debt, and then finally you issue new equity last. So the first thing you do is you use up your internal financing to get rid of all the cash, sop up all that cash so they don't use it for lavish perks. The second thing you do is issue debt because you can write it off, and it leverages the firm, which gives you a bigger return for your shareholders. And then finally, you issue new shareholders or dilute the company slightly because you need that money to grow the company. So that would be the third thing you do. The pecking order theory is at odds with the trade-off theory in that there is no target debt to equity ratio. Profitable firms you will end up using less debt because they will be using internal financing, and companies like financial slack. And of course we like financial slack because like cushion. We've talked about cushion quite a bit. So there are little differences in these theories, and of course it depends on if you're a growth company or if you're a large mature company that doesn't need additional financing and so on. And of course it means profitability. Also, one of the factors is profitability. If you're very highly profitable, you can use a lot of internal financing, especially if you have low capital requirements, which is another factor, is how much capital requirements. Certainly an internet company is going to have lower capital requirements than Boeing or a railroad or a car company. So these are factors in determining what your capital structure is. These theories play into deciding whether you're all equity or debt plus equity, or even all debt with just a smidgen of equity in there. So these things get into the capital structure issues. There's not too much more to cover on this. I think we probably move on to short-term financing. But that is a way of thinking about how much debt and how much equity a company should actually have.